human brain is an exquisite piece of evolutionary engineering, designed for one primary directive: survival. For hundreds of thousands of years, our ancestors survived by recognizing patterns, fleeing from immediate danger, and seeking absolute certainty. If you heard a rustle in the bushes, assuming it was a predator kept you alive. When you walk into the modern financial arena, that exact survival mechanism becomes an invisible anchor, dragging you to the bottom. Consider this paradox. The more you try to protect yourself from losing, the more certain you are to lose. In everyday life, control equals safety. If you practice a skill, study the data, and exert maximum effort, you expect a predictable, successful outcome. But the moment you place a trade, that rulebook is set on fire. The market does not care about your effort, your intelligence, or your need to be right. It is a mirror that reflects your deepest psychological vulnerabilities. When you stare at a chart, you aren't just looking at price action. You are looking at your own relationship with fear, greed, and validation. Most traders spend years looking for the perfect indicator, the holy grail that will guarantee success. They look outward because looking inward is too painful. They refuse to accept that their losses aren't caused by a flawed strategy, but by a flawed operating system running inside their own minds. By the time this video ends, you will see the charts differently. More importantly, you will see yourself differently. We are going to dismantle the psychological traps that keep 95% of market participants trapped in a cycle of frustration, using the profound, timeless trading psychology principles defined by Mark Douglas. To understand why your mind misinterprets risk, you must look at the foundational truth established by Mark Douglas. Market is a continuous stream of random, unrepeatable events. While technical patterns exist, the outcome of any specific setup is completely independent of the last one. If you can learn to accept the fact that each individual trade is a unique, random event, you will instantly eliminate the fear. Douglas realized that most traders are operating with a fundamental mismatch in their thinking. They use a deterministic mindset in a probabilistic environment. Your brain wants to know for sure what will happen next before it risks money. It wants certainty, but the market operates entirely on percentages and probabilities. When you force your brain to find certainty where it doesn't exist, you create an intense psychological conflict. This conflict triggers a defensive reaction. When you feel that intense, burning urge to jump into a trade without a plan, or when you hesitate and let a perfect setup pass you by, you aren't fighting the chart. You are fighting your own brain's inability to accept the unknown. True consistency is achieved only when you stop trying to predict the future and start mastering your mind's reaction to the present. Douglas codified his observations into core psychological pillars that transcend time, technology, and asset classes. To build an unshakable mindset, you must integrate these three golden principles deeply into your subconscious execution. The three golden pillars of mindset. The pillar of the random outcome. You do not need to know what is going to happen next in the market to make money. A strategy only requires a statistical edge over a sample size of trades, not a guarantee on the next one. The pillar of predefined risk. Every trade carries the potential for failure. If you haven't completely accepted the exact dollar amount you could lose before entering, your brain will treat the trade as a direct threat. The pillar of carefree execution. To trade without fear, you must become emotionally neutral. Your self-worth cannot be tied to whether the current position hits your target or your stop loss. Think about how these pillars apply to your daily trading. How many times have you watched a market move violently, felt your heart rate accelerate, and clicked buy or sell purely on impulse, only to watch it instantly reverse? That happens because your mind didn't truly accept the risk before clicking the button. Your brain perceived the rapid movement as an instant reward, completely ignoring the potential downside. Douglas taught that the market is a mirror. If there is chaos inside your mind, there will be chaos in your results. Many traders spend years jumping from one trading strategy to another, searching for a system that never loses. They believe that if they just find the right combination of indicators, they will finally overcome their consistency issues. This is what Douglas called the ultimate illusion of the marketplace. Search for a flawless system is driven by impatience and ego. Most traders confuse a technical strategy with a psychological edge. In almost every other profession, the harder you work, the more information you gather, and the more tasks you complete, the more successful you are. In trading, the opposite is frequently true. Overanalyzing and gathering too much data is a symptom of underlying anxiety, a desperate attempt to control an environment that is fundamentally uncontrollable. Sitting patiently and executing your defined edge without hesitation is where the real money is made. It means having the emotional maturity to wait for your plan to validate itself before risking your hard-earned capital. It means resisting the constant dopamine cravings of your brain, which views every single tick of the chart as an invitation to act. To combat the natural tendency of the human mind to overreact during live market conditions, we must establish strict mechanical rules that remove human emotion from execution. One of the most effective psychological filters inspired by the principles of strict risk management is the fixed percentage risk filter, such as risking no more than 1% to 3% of your capital on any single position. Douglas argued that a professional trader views a loss simply as the standard cost of doing business. However, when an amateur risks too much capital on a single trade, their survival brain triggers a defense mechanism known as loss aversion. Behavioral psychology proves that the pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain. When a trade moves against you and you are risking too much, your brain denies reality. You tell yourself, it will come back, or I'll just hold it until I break even. By refusing to accept a small, controlled risk, you leave the door wide open for a catastrophic loss that can wipe out weeks of discipline. A strict percentage risk rule isn't just a mathematical formula. It is a psychological shield designed to protect your ego from destroying your account. The root cause of almost all trading errors is the illusion of certainty. Your brain is a prediction machine. When you see a specific pattern on a chart, let's say a perfect support bounce, your mind immediately searches its database of past experiences. It remembers the last time you saw this pattern and it worked beautifully. It creates an expectation of a specific positive outcome, and that is exactly where the trap snaps shut. Because there are thousands of market participants across the globe executing orders for thousands of different reasons, the outcome of any specific setup is completely random. You can have a pattern that has a 70% historical win rate, but you can never know if the specific trade you are taking right now will be part of the 70% that win or the 30% that fail. The professional trader accepts this fundamental truth. The amateur trader merely claims to accept it. When the amateur takes a loss, they feel hurt, betrayed, or angry because their brain expected to win. When you expect to win and you lose, your brain interprets that mismatch as a threat, flooding your system with stress hormones. Suddenly, you are no longer a rational investor. You are a cornered animal trying to fight back against the market. Let's look closely at what happens inside your nervous system during a live trading session. You have been waiting all morning for a specific, high-probability setup finally appears. The plan says, enter here. But instead of executing smoothly, you freeze. You hesitate. You tell yourself you want to wait for just one more confirmation candle. The market moves without you, skyrocketing straight to your target. You feel a wave of intense regret and anger. Why did your brain sabotage you? This behavior is rooted in the amygdala, the emotional epicenter of the brain. If your previous trade was a painful loss, your amygdala remembers that emotional trauma. When a new setup appears, even if it is a completely independent event, your brain associates the act of execution with the pain of the previous loss. It tries to protect you from future pain by forcing you to hesitate. Once the trade leaves without you, a new psychological bias takes over. FOMO, fear of missing out. Your brain experiences a sudden drop in dopamine. To fix this, you chase the market, entering at a terrible price out of sheer desperation. You have just completed the classic cycle of self-sabotage. You let fear keep you out of a good trade, and greed pull you into a bad one. To break this cycle, you must train your brain to realize that a single trade is completely meaningless. It is merely one instance out of a large sample size of your edge. How do you transition from an emotional speculator to a cold, efficient market operator? It requires an identity shift. You must stop defining your success by the outcome of individual trades and start defining it by quality of your execution. Consider a professional card player. If they hold a statistically dominant hand and lose to someone who drew a lucky card, do they get angry? Do they change their entire strategy? No. They understand that over 1,000 hands, the math will work in their favor. They don't care about winning this hand. They care about playing the probabilities correctly. The amateur trader plays the market like a casino slot machine, looking for a quick hit of validation and profit. The professional trader operates like the casino itself, Casino knows it will lose money on certain tables and certain nights, but it sleeps soundly because its mathematical edge guarantees profitability over time. When you adopt this probabilistic mindset, your relationship with losses changes entirely. A stop loss is no longer a sign that you were wrong. It is simply the cost of doing business. To build a mindset capable of standing alongside the true professionals, you must establish a rigid daily protocol that protects your brain from decision fatigue. The more decisions you make throughout the day, the weaker your self-control becomes, making you highly vulnerable to impulsive behavior. Here is your structural blueprint for psychological resilience, based on Mark Douglas's The Principles of Discipline. Do not open social media, news feeds, or profit and loss balances. Calibrate your mind to neutrality. Write down your explicit criteria for a valid setup. If the market does not present these criteria, your definitive goal for the day is to exercise the discipline of doing nothing. Apply a strict execution filter. When a setup occurs, execute it without hesitation. Remind yourself that this trade is simply one of the next 20 trades that will define your edge. Never market order out of panic or chase a missed move. The moment an order is filled, your stop loss and take profit targets must be placed automatically. Once active, step away from the screen or switch tabs. Staring at every minor fluctuation triggers the amygdala, tempting you to micromanage and violate your initial plan. Review your journal. Do not grade the day based on money made or lost. Grade it entirely based on how perfectly you followed your rules. If you lost money but executed your plan perfectly, score yourself a 10. If you made money but broke your rules, score yourself a 0. The secrets of market mastery have never changed because human nature has not changed. The technology evolving around us is infinitely faster, but the biology inside us remains identical. The ultimate edge in trading is not a secret algorithm, a private indicators channel, or a faster computer. The ultimate edge is self-awareness and the ability to think in probabilities. It is the rare ability to observe your own emotions in real time without reacting to them. When you feel fear, you acknowledge it, but you execute anyway. When you feel greed, you recognize it, and you step back. You are not fighting the market. You are fighting your own biology. The charts are simply a blank canvas upon which your psychological drama is projected. Master your mind, master your internal states, and the profit will naturally follow as a byproduct of your internal order. If this perspective shifted something within you, make sure to subscribe to Market Mind Edge. Leave a comment below sharing which psychological trap, loss aversion, hesitation, or chasing trades, has been your biggest silent enemy. Drop a like to help this video reach other ambitious minds who are tired of fighting the charts and ready to master themselves.